On August 26th, the three major U.S. stock indexes rose and fell. The Dow Jones Industrial Average closed up 0.16% at 41,240.52 points, a record high. The Nasdaq fell 0.85% to 17,725.77 points, and the S&P 500 fell 0.32% to 5,616.84 points. Technology stocks performed weakly, with Google up 0.33% and Apple up 0.15%. Microsoft fell 0.79%, Amazon fell 0.87%, Facebook fell 1.3%, Nvidia fell 2.25%, and Tesla fell 3.23%. Apple fell 1% after the market. Apple has just announced that it will hold a special event at 1 a.m. Beijing time on September 10th, with the theme of Highlight Moments. It is expected that Apple will release the iPhone 16 series, AirPods 4, and the new generation of Apple Watch series at this event, and iOS 18 and macOS Sequoia will also be officially released. In addition, Apple announced that Kevin Perek will replace Luca Maestri as Chief Financial Officer, CFO, effective January 1, 2025. Kevin Perek is currently Apple's Vice President of Financial Planning and Analysis. Nvidia will disclose its financial report after the market closes on Wednesday. Baird analyst Ross Mayfield said the technology industry is somewhat concerned about Nvidia's upcoming financial report. The market is in a fairly healthy state, but if technology stocks lag behind, it will be difficult to rise sharply. It has too much weight in the index, and now it is acting like a laggard. Most bank stocks rose. JP Morgan Chase rose 0.41%. Goldman Sachs fell 0.27%. Citigroup fell 0.56%. Morgan Stanley rose 0.44%. Bank of America rose 0.4%. And Wells Fargo rose 0.05%. Energy stocks rose collectively. ExxonMobil rose 2.15%. Chevron rose 0.6%. ConocoPhillips rose 1.95%. Schlumberger rose 1.07%. And Occidental Petroleum rose 0.24%. Most airline stocks fell, with Boeing down 0.82%, American Airlines down 1.73%, Delta Airlines down 0.95%, Southwest Airlines up 0.09%, and United Airlines down 1.25%. Popular Chinese stocks generally fell back, with Pinduoduo plummeting more than 28%, and the company's second quarter performance fell short of market expectations. The Nasdaq China Golden Dragon Index fell 0.76%, Yatsen e-commerce fell more than 7%, Baijiayin and Youdao fell more than 6%, Ruxin Technology fell more than 5%, Bilibili, Haichuan Securities, and Alibaba fell more than 4%. Shanda Technology, Jiwen Group, Yadwa, JD.com, and New Oriental fell more than 3%. Tuya Smart rose more than 9%. Xiaoping Motors rose more than 7%. Jihu and IMAB rose more than 6%. And Yo Electric and Kingsoft Cloud rose more than 5%. The U.S. Consumer News and Business Channel, CNBC, said that the Dow Jones closed higher at a record high as investors tried to get rid of the sharp sell-off earlier this month, and the market seemed to be shifting from technology stocks to other market sectors. After the market boom on Friday about the Federal Reserve's upcoming rate cut, U.S. stocks quickly returned to a stable state on Monday. As recession fears gradually fade and the loose monetary policy cycle begins, investors are now more focused on future economic data to assess the possibility of a soft landing. Historical experience shows that this will be one of the key factors in the future trend of U.S. stocks. Rate cuts do not mean the beginning of a bull market. After the Fed's meeting minutes hinted at a possible rate cut in September, Powell's speech at the Jackson Hole Global Central Bank annual meeting made the timing of the policy shift clearer. According to interest rate futures pricing, the Fed may cut interest rates by 25 basis points in September. However, a shift in monetary policy does not usually mean the arrival of a bull market. Although the S&P 500 has risen 18% this year and market valuations are at historical highs, investors still need to see more evidence that economic growth can remain resilient while inflationary pressures ease, so as to achieve a soft landing. Lonkeys, senior portfolio manager and investment director at Invesco Asset Management, pointed out, "The market certainly expects the start of a rate cut cycle, but what is the Fed's real concern? This should have a different impact on the rate cut cycle." Richmond Fed President Barkin recently wrote that the current low hiring, low firing strategy of American companies may be unsustainable. He pointed out that if the economy weakens, companies may face the risk of layoffs. Recently, the Fed's concerns about the job market have intensified, and Fed Chairman Powell emphasized the need to cut interest rates to prevent further increases in unemployment. If demand continues, companies may start hiring again. Otherwise, layoffs may occur. Barkin said, "Historical experience shows that if interest rate cuts occur when economic growth is still resilient, U.S. stocks tend to perform stronger." In the context of the recessions in 2001 and 2007, the Fed's interest rate cuts triggered significant adjustments in the stock market. Evercore ISI strategists pointed out that since 1970, the S&P 500 has risen an average of 18% in the first year after the first interest rate cut in non-recessionary periods. During recessions, this increase has shrunk to 2%. UBS pointed out in a report that the Fed officials' inclination to cut interest rates is consistent with its forecasts as the labor market cools faster than expected and inflation continues to slow. The agency expects the Fed to start cutting interest rates in September and cut interest rates once at the November and December meetings. UBS also found that the Fed's interest rate cuts in non-recessionary periods are usually good for the stock market, so it remains optimistic about high-quality growth stocks. Potential risks and challenges. Before the next Fed interest rate meeting, at least 3 key economic reports are about to be released. The Personal Consumption Expenditure Price Index, PCE, on August 30th, the Non-Farm Payrolls Report on September 6th, and the Consumer Price Index, CPI, on September 11th. The previous non-farm report has triggered recession fears. If more signs of economic weakness emerge, it may disrupt the market again and shift expectations of interest rate cuts to 50 basis points. Crosby, chief global strategist at LPL Financial, pointed out that the market welcomes the start of the interest rate cut cycle because inflation is slowing, but the key question remains whether the labor market will deteriorate further. On the other hand, the market is about to enter a traditional seasonal weakness period. September is typically the weakest month for stocks, with the S&P 500 falling an average of 0.78% in September since World War II, according to the Center for Wealth Research and Analysis, CFRA. Rising stock valuations could dampen investors' willingness to hold shares if negative news emerges. According to LSEG DataStream, the S&P 500's current forward price-to-earnings ratio has risen to 21 times, close to its historical high, higher than 19.6 times in early August, while the long-term average is 15.7 times. At the same time, the upcoming election may also trigger market volatility. The latest polls show that Democratic presidential candidate and current Vice President Harris has a close approval rating to former President and Republican candidate Trump, and the difference in their policy positions may trigger changes in market risk preferences as the election approaches. Buckhouse, managing director of Ingenium Analytics LLC, pointed out, "The long-term trend of the stock market remains solid, and any short-term weakness may be an opportunity to increase risk exposure. However, volatility and instability may increase in the short term because no one can accurately predict the specific impact of the Fed's rate cut before the election." It should be noted that according to the latest analysis of Goldman Sachs' prime brokerage department, hedge funds have been cautious in the recent market rebound, and fund managers have generally reduced their exposure to the stock market, selling at the fastest rate since March 2022. Despite the market rebound, both total leverage and net leverage ratios declined in August, indicating that risk appetite has not yet recovered. Schneller, managing partner of Erlen Capital Management, explained, "Despite the overall market sentiment being more optimistic, hedge funds seem to be skeptical about the sustainability of the rebound and remain alert to potential headwinds." He believes that hedge funds are taking downside protection measures while waiting for the economic and market outlook to become clearer. They are worried that the market's optimism may be premature and economic conditions may deteriorate before the interest rate cuts take effect, leading to a new round of economic recession. Bill, managing director of Dynamic Beta Investments, also said that many hedge funds choose to wait and see when faced with uncertainty, waiting for clearer signals before taking action. Some institutions are worried about losing the gains made in the first half of this year. They are cautious from the perspective of risk-return of global changes, especially against the backdrop of geopolitical tensions, and are worried that economic recovery may encounter obstacles.